check out the safe wheel strategy for beginners, never be afraid of market crashes again, buy options with Davis. I want to be fair and not be super critical of Davis because I think that he has good intentions. And when I make videos about other people, I really only go hard at them if I feel that they have bad intentions. Someone like Invest with Corey or Felix Pren from Gold Academy, I think that those guys are some of the worst predators that I've ever reviewed. Overall, I think that Options with Davis is a pretty solid person to learn options trading from. However, I do think that running the wheel strategy is not good at all. In fact, every single covered call ETF dramatically underperforms the market. Probably the best performing one would be JEPI, which has not really lost much value. And despite having an 8% dividend, you're still paying short-term capital gains on that. So on a net basis, you're getting about 6%. Some of the other covered call ETFs have even lost money. So here you can see for JEPI, it's currently trading at about 55. And it started out in the middle of 2020 where it was also trading at about 55. So it hasn't gone anywhere. And on an after-tax basis, you're getting about 6% a year. If you want to look at DYLG, you can see that this is dramatically underperformed. If you want to look at QYLD, which has been around for a while, you can see that this was offered to the public at $26 back in 2014, and now it's trading at $16. And yeah, the dividend, great. You're going to make a lot of money on the dividend, right? So you're making about 13%, then after tax, you're making about 10% a year, but then it's lost a tremendous amount of value. So you would have been way better off just simply holding the S&P 500. And the reason why the wheel strategy dramatically underperforms is that during a market pullback, you're losing dollars and you're only making pennies when you're selling the covered calls. Then when the market rebounds, like it did in earlier 2025, when the S&P went up 9 straight days after the market fell by 20 or 30%, your upside is capped because you traded that upside for a few pennies by selling those covered calls. So as you can see, I'm not a fan of covered calls at all, but let's see what Davis has to say in his video.
Okay, so in this video, I'm going to be sharing with you a much safer way for you to trade the wheel strategy, especially if the market crashes, because this is one of the things that many people fear when they start trading the wheel strategy. Not many people actually have a concrete plan as to what exactly to do when the market actually crashes.
So my gut feeling is that he's going to use some type of vertical credit spread, or he's definitely going to have to buy some type of protective put in order to reduce the downside potential. But let's see what the video says.
It's where a lot of people get into the wheel strategy, the market suddenly crashes, go well below their options, they're deep in the money, and they're seeing a very deep loss, then they panic, right? So that is actually what happened over the past few weeks when the tariffs hit the market and all of a sudden the market had a very big move down. So during those past few weeks, I actually had quite a...
And then what also happens when the market crashes and then people are selling covered calls below their cost basis, they're actually locking in their losses because as the market rebounded, they weren't able to participate because their shares got called away.
A number of people reach out to me asking me for help because many of their positions are deep in the money and they have no idea what to do. So let me just give you an example over here, and that is on Nvidia. And the reason I chose this is because I had somebody actually reach out to me to let me know that they did the wheel strategy before the market crash, right? Before Donald Trump actually introduced the tariffs. The person entered into the wheel strategy by selling the cash account put first at around $140, somewhere around here. So as you can see over here,
wow, that's horrible.
This is where he sold his cash account put, and after selling it, the market has gone.
If you're selling puts on Nvidia at 140 when Nvidia is trading at about 144, 145, then you're trading way too aggressively and not respecting the downside potential. I think that Nvidia fell below $90. So this person had a loss of about $50 a share.
Much lower than that, and he has gotten a sign and is seeing, a very big loss. So this is where a lot of people have no idea what to do because they just enter into the trade thinking that they're just only going to collect the premiums with no intention of getting a sign. And then when it actually goes below the cash account put, they become a deer in the headlights. 4 key steps. So the very first step is regarding stock selection. Second step is trade placement.
Let's see what his actual trade structure is, and then I'll give you my opinion. His videos have a tendency to run a little bit long.
Third step is see is not a fundamental.
You only want to sell put options on a stock that you want to take ownership on.
Get on over to Google Finance and just look at the stocks that you're interested in. One cash account put as to enter into the trade. So let's just say, for example, you have $50,000 just to put into a certain stock. Most people just enter into one level. But what we want to do instead is to split into different tranches. So let's just say, for example, you have decided that maybe you want to enter at $115 as an example. You want to do your cash account put down here. So if your risk for this stock, let's just say, is $50,000, then you're probably looking at about 4 cash account puts, 4 contracts or so. So instead of doing all this in just one position, what we want to do is we want to split them into tranches. That means to say we do not want to enter all 4 contracts right now, but rather we just want to enter one here, and then we want to split them up into different levels. So what does this do? This number one, it does is that you can continue to sell this cash account put even as the market goes down.
But that doesn't necessarily make sense because very few people would sell a put option on Nvidia 115 with the expectation that it's going to get challenged and that they're going to get assigned. So then, if you're only going to sell one put option at 115 and then Nvidia ends up going up, then you've basically only allocated 25% of your account and you're sitting on the remaining 75% just waiting for a pullback. So this type of strategy, you're basically not going to earn anything except a small return on the 25% that you're allocating.
Get stuck doing is basically they sell the cash account put their full position at one level. Let's say, for example, here, then all of a sudden the market crashes, they get assigned, then there's nothing left to do. All they can do is just to hold on to their stock.
When we sell a put option, we don't know what the market is going to do. If we did know what the market was going to do, then we would actually buy options and profit from the directional moves. So if we sold a put and then we knew that the market would crash, then we actually wouldn't sell a put. Instead, we would actually buy a put because we would make substantially more money on the purchased put than we would on the sold put. So this type of strategy, when you're only allocating a certain amount of money, then there's an ingrained assumption, which is completely false, that you know what the market's going to do. Instead, if you're only going to trade with 25% of your account and you're not using any type of margin, you're going to earn about 2 to 3% a year on your entire account. You're better off just putting your money into a certificate of deposit.
Like what I mentioned just now of this other person that reached out to me, he had at $140. All he's doing right now is that he's holding on to the stock, waiting for it to eventually recover. So this is one of the limitations when you have just one level. So instead, when you have more than one level of entering, you split them into different tranches, then this way, as the market goes down, you can keep selling it as well. So not all will necessarily be assigned at the same time. So let's say, for example, the market comes down, it expires here, then this one now becomes 100 shares. So once this is 100 shares, now you have another one, you can keep selling it.
This is so foolish, but it's also disappointing because I would have expected this type of quality from something like trading with Ashley, not options with Davis. This strategy is very foolish, and the reality is that using this trading strategy is probably going to underperform simply putting all your money in a certificate of deposit, which carries virtually zero risk.
So this one, you can sell the cash account put again, and for average price would most likely be somewhere over here, as compared, the thing I look at is to see whether it's below the fair value. Now this one is not necessarily mandatory, it can be optional, but if you use it, it's going to help you err more on the safe side. So the question is, how can you find out about the valuation of the stocks that you are planning to do the wheel strategy on? So as you can see over here, this is a site where it can tell you quite a number of things about the stock that you're planning to do the wheel strategy in. So you can see over here, these are some pretty interesting details for you to know. Earnings are forecast to grow at 20.7% per year, trading at 5.3.
Unfortunately, fundamental analysis has already been factored into the stock price, and looking at the financial statements is not going to help you evaluate future price performance in the market. Now, there's a caveat to that. You can look at the historical and overall price earnings ratios to see how the market is valuing the stock now relative to the valuation that is given previously. But overall, I'm not a big fan of looking at fundamental analysis.
Is this valuation 100% accurate? Of course not, right? Because valuation is really derived based on different calculation depending on the person. So what you can do is to go to the other sites as well. You just do a Google search and there's going to be many different sites that will give you their fair value of what they think about the stock, and then you can get an aggregate out of all of them. So for example, if you see that the fair value is 137 based on this website, then maybe if you want to be safe, you can say that, okay, the fair value is 130. Then you only initiate the wheel strategy below this fair value. So now step 3, we're going to get into option selection, and same thing, we're going to get into two things down here. So the first will be DTE selection, second will be strike. Two choices in general. Either you can go for the very short-term one. The very first thing is you want to decide what is the DTE to choose. So you're pretty much faced with just two choices in general. Either you can go for the very short-term one, and what I mean by that is maybe a week or so or less than that, or something around 45 DTEs or so. However, when it comes to the wheel strategy, this to me doesn't really play too big of a part, because
he just said that you're concerned that the market's going to crash. If you're concerned that the market's going to crash and you're forced to sell put options, you want the DTE to be as short as possible. If you go out 45 days and then the market crashes in a week, those options that you sold, and let's say hypothetically you picked up $1, they might be trading at $6 or $7 and they might be showing you a massive loss. So if you truly believe that the market's going to crash in the near future, you want your DTEs to be as short as possible.
I'm not trying to avoid assignment, but rather I actually do welcome the assignment. That is part of the wheel strategy, because a big part of the profits that you're going to gain from the wheel strategy actually is the capital gains. That means you get assigned on the stock, and then from there, when the stock actually goes above your assigned price, you're going to get capital gains. So you want to get all three types of profit from here. Basically, the premium you get from selling the cash account put, the premium you get from the covered call, and then also the capital gains. So if the focus really is to get assigned quickly, then you want to go for the lower DTE as well. Because with the lower DTEs, it gives you a higher probability of getting assigned.
If your goal is to get assigned and you think the market's going to crash, then you would want to choose the short-term options as opposed to the longer-term options.
Market actually goes below that strike price, because there are lesser days for you to wait. If you go for the 45 DTE one, what can happen is that the market may go down maybe within the first 7 days of putting on this option.
And then you're stuck.
And then closer to its expiration, it goes up and then you're no longer assigned.
Well, the bigger issue is that let's say you sell 45 days DTE, and then within 7 days of you selling the initial put option, the market crashes by 15%. In that situation, the option that you sold for maybe $2 is going to be trading somewhere between $10 and $15. So that option is going to show you a major loss. Whereas if you had sold a lower DTE, then you could roll that option down. You can use the higher implied volatility to extend the duration on that option and to reduce the strike price as well.
But had you actually gotten into the stock and the price really did continue to go up, then you would have actually gotten much more than the premium which you receive for selling this option. So that is why this is where you need to really decide for yourself whether you want to prioritize getting assignment, or do you want to just prioritize, getting more of this premium. Remember, it's always a trade-off. So one thing you need to understand is when you go for a shorter DTE, you can't really get a further out of the money strike price. So for example, let's take a look at the chart again. The price you're looking to probably get assigned at will be around 115. This is where you're planning to sell the cash account put. Now, if you were to go to the 3 DTEs and you want to sell the 115 strike price, take a look at what is the premium. As you can see over here, the premium pretty much is next to nothing. It's only 6 to 7 cents. You're pretty much not going to get much for selling this strike price. But if you were to go to the further out of the money one, and you take a look at the 115 strike price, you can see that actually you can get a little bit more, right? In fact, much more. You get about $270 per option contract. So this is something that you need to realize as the price goes down on the chart.
All right, I'm going to skip through and see what else he has to say.
We get into step 4, and that is trade strategy. And that is to have staggered cash account put entries and staggered covered call entries. So like I mentioned earlier, we're going to be getting it into tranches, but that doesn't mean that we sell everything at one go. For example, let's just say the very first level you plan to enter will probably be, say, 120. And then maybe after that, the next one will be probably 110. And then the next one will be another 10 points out at 100. And then at $90. Let's just say, for example, this is what you've decided to go with. By the way, there's no one fixed way for you to do this. This is up to you to arrange it the way that you feel comfortable. So let's just say you want to go with this. You do not immediately sell all 4 of this cash account put at one go. Why? Because chances are that you won't get any premium for this bottom 3 because they're...
Again, if you're only going to allocate 25% of your account, especially when you're using cash secure puts, you're not going to make any money. You're better off just putting your money into the bank account and not taking any risk. He's basically telling you to just sit on 75% of your account for fear that the market's going to crash. That doesn't make any sense to me.
Just too far out of the money. So what we want to do instead is to stagger our entries in a sense whereby only at the start you want to start off with this first one. So as the market maybe comes down, this is where you want to decide, do you want to sell at the money or further out of the money, and then based on the strike price level that you want, and then you start to sell the first cash secure put. Only when the market goes lower from the first cash secure put, then you can start to put on the second one. And when it goes to the next one, you get into the next one as well. So as you can see, we are always...
Yeah, again, if we knew that the market was going to go down, then we would either short sell stock or we would buy puts. We're not going to sell puts if we know that the market's going to go down. And we're not only going to trade 25% of our accounts by collecting premium, because by doing that, you're barely going to make any money.
Staggering it. So same thing, if the market goes back up and then this 2 starts to expire worthless, so now you no longer have this 2 cash account put, then at this point of time, because it's below this 120, you can start to sell this one again. So you sell this one again, and then same thing, you wait for it to go down before you sell this one again. So as you can see, we're always staggering the cash account put rather than entering it all at once. Now this also works on the other side, which is the covered call. So let's say, for example, you are already now assigned on these 2 levels. Let's just say you got plus 100 over here, and you have another plus 100 shares over here. Then this is where you only want to sell the covered call for each individual level once it goes above that level. So let's say, for example, it comes to this point. This is then where you sell the first covered call.
What he's recommending is so complicated, especially for something that's going to dramatically underperform the market. This video reminds me of something that Trading with Ashley would put out, where it's just a half-cocked, theoretical, dumb idea that's going to dramatically underperform the market. And it seems like he's just making content to put a video out, but the actual trading idea that's presented in this video is, in my opinion, complete garbage. If you like this video, then watch the video that's popping up on your screen right now, because YouTube believes that you would enjoy it the most.